The top business stories live from the Sky News City studio. Wet weather dampens retail sales volumes, which fell by more than expected last month. Energy bills to fall for millions as Ofgem lowers the household energy price cap by 7% from the beginning of July. Plus, the chief financial officer of Marriott International, the world's biggest hotel company, tells me she wants the next UK government to create a solid financing environment for growth. Good afternoon, this is Business Live with me, Ian King. Retail sales fell unexpectedly last month due to the exceptionally wet weather. The Office for National Statistics said retail sales volumes in April were down 2.3% from March. It also revised lower the figure for March itself, and retail sales volumes are now thought to have been down 0.2% from February instead of being unchanged as previously assumed. Non-food stores sales volumes fell by 4.1%, which was the joint biggest fall since January 2021, with clothing retailers, sports equipment, games and toy stores and furniture stores all suffering. Meanwhile, household energy bills will fall this summer after the energy regulator Ofgem announced it was lowering the price cap by 7%. The cap, which limits what can be charged per unit of energy, will fall to a level where the typical annual bill will be £1,568 a year, compared with the current £1,690 a year. It means the average annual energy bill will be £506 cheaper than a year ago. However, before Russia's invasion of Ukraine in February 2022, a standard 12-month bill was £1,084. And the research firm Cornwall Insight predicts that prices will increase again coming into winter as wholesale gas costs rise, with the typical bill increasing to £1,762 from October. Now, the Chief Financial Officer of Marriott International has told Sky News she wants the next UK government to create what she called a solid financing environment to help grow. Leni Oberg was speaking after the world's biggest hotel company announced a better start to 2024 than expected and plans to raise its investment this year to as much as $1.2 billion, much of which will be spent on technology. I began by asking her, though, if she'd been pleasantly surprised by the way the year had begun.
I think with the exception of the US and perhaps China, which has also been a little bit slower than we expected, I would say international really hit it hard and did really well. When we think about Asia Pacific outside of China, it's 16.5, and Europe and Middle East Africa at double digits growth of essentially our equivalent of same-store sales, which is called RevPAR. Really impressive results.
What about in China itself then? Obviously, we had the Chinese New Year during Q1, which is normally a big driver for activity.
No, I think it was still a strong quarter at 6% year over year. But if you remember a year ago in China in the first quarter, there still was really not much travel. So I think the reality is that some of the forward booking trends, they looked all right, but perhaps not quite as robust as we had imagined.
Also came away with the sense from your latest numbers that business travel is a lot more resilient than leisure.
Well, leisure came out of the box first. I think there was the reality that everybody felt they'd been closed in those four walls for way too long. So leisure absolutely leapt out as soon as COVID began to lift. So they really led the charge. And then behind it, you've had business transient as well as group. And now what we're seeing as you see companies really being back in the workplace, you're seeing that group is quite strong and forward-looking bookings for group is excellent. And business transient has been interestingly slow to build, but continues to build. And so I think to your point, we like seeing the demand strength across all three segments.
Now, you've said that you'll invest up to $1.2 billion this year. A lot more on technology than previously. What kind of projects are you investing in?
So there's a tech transformation that we're doing at Marriott that is really quite robust. And it spans the range from as you even dream of your travel plans and how you want to go on your app and explore, whether it's places or activities or kinds of rooms. We want you to be able to search any which way that you like. But then we want to be able to communicate with you well and easily throughout the business, throughout the travel that you want to do with us. So it is fantastic for the customer, great range of things that you can book, and actually will allow you to go on to doing your bookings for the spa, for the tennis court, for the restaurants. But then it's also going to be easier for the associate and also more efficient in terms of our ability to service the guests. So a really spectacular transformation that we will see over the next 2 years.
You've also set up an AI incubator. What sort of things are you trying to do with that?
Well, I think of it in really two sets. One is internally, as we think about, for example, in my shop, in the finance role, where you're trying to do things quicker and more efficiently, really automate some things that before people were having to rack up on the spreadsheets. And that is, I think, really about doing things more quickly. Really, when I think about the customer, it takes on a different cast where, of course, you're wanting to offer the customer easily and quickly great ideas, but you also have to be really careful with AI. The first time you have an AI search that offers something ridiculous to a customer, that's not good. So the way that we're working with AI is to be very thoughtful, have really careful guardrails, thoughtful ways that we approach it within the company to make sure that the way that we're doing it for the customer is perfect.
Now, you're here in London to see your investors, and it's great to have you here with us. We've just had an election called in this country. As a big investor in the UK, what would you want to see from the next government, whoever they may be?
Well, as you might imagine, for us, the overall macroeconomic picture is extraordinarily important for the drivers of demand for our business. And also a solid financing environment. As you think about it, a whole lot of our business is about either building or investing in properties and in fundamental consumer demand. So healthy economies are healthy, growing economies are terrific for our business.
Some other business news stories for you now. And the water regulator, Ofwat, said today it will delay an announcement on the extent to which water companies will be able to invest and to raise household bills from next year. Ofwat had originally planned to announce its final determinations for the 2025 to 2030 regulatory period on the 12th of June. But it said today that in view of the general election, it will not publish its final determination until the 11th of July. The decision is being seen as critical, in particular, for the future of Thames Water, whose shareholders recently refused to inject more equity into the business unless Ofwat raised the sum by which the company will be allowed to increase prices. The energy and engineering services company Wood Group said today it's rejected a third takeover approach from its Middle Eastern suitor, Sidara. Wood Group said the latest approach from the Beirut-based company, valued at £1.52 billion, which was an improvement of 3.8% on its previous offer. Wood, which is based in Aberdeen and which employs 35,000 people worldwide, said the offer continued to significantly undervalue it and its prospects. And the chief executive of investment company and asset manager Aberdeen unexpectedly stepped down today. Stephen Bird had been in the role since September 2020. During his time, he's overseen the company's name change from Standard Life Aberdeen to Aberdeen. He's bought the investment platform Interactive Investor, and he's sold or restructured underperforming parts of the business. He'll be replaced on an interim basis by Jason Windsor, Aberdeen's chief financial officer, who's seen as a leading contender to take up the role on a permanent basis. Now, a legal tech solution that started out with the aim of helping people with visual impairments to navigate legal documents is now being used by law firms around the world. Definely was founded by two lawyers, one of whom is registered blind. It's just raised $7 million in its latest funding round. Well, I've been speaking to its founders, Nnamdi Emeifeolu and Fergus McDade, about how it all started.
It initially started out as a solution to help me when I met Nnamdi at Freshfields, in terms of accessing relevant information in a way that's going to be efficient and meaningful. Because when I was doing the work, my disability, I was trying to complete the same tasks that other solicitors were doing. But for me, because of my disability and the fact that I use assistive technology, that problem was much more acute. So I think like Nnamdi and I started sitting down and talking about, well, what would an ideal solution look like for me, It just turned out that the ideal solution for me happened to be something that would help lawyers everywhere, because at the end of the day, there were still the same tasks that everybody does. So for example, when you're reading and reviewing a legal contract, there are certain things that you must always look for or go through when you're trying to make sense of a provision within that contract. So you're always looking for your defined terms, your cross-references, and other clauses. And I suppose the problem for me was that in order to accomplish that task, I was always losing the position that I was in on the document. So some of these documents were huge, you know, they'd be like 100, 200 pages, and you could be on page 130, and all of a sudden you're having to go back to the beginning of the document to look up the meaning of a defined term, or you have to scroll down further, or Control F, or, you know, a lot of lawyers generally would have the copy printed out on the table beside them, and they would just reference off that. So what Nnamdi and I really recognized was that there's certain patterns to how this information was set out in the documents. And I think once that penny dropped with us, I think that was when we went to prototype it and then go, actually, this is something that really works. But fundamentally, and I think the reason why the product has been so popular is that it's actually not something that solves a pain point for me, but it solves a pain point for every lawyer. And I think what you end up with is this kind of classic design scenario where when you actually solve some problem for the edges, you get the whole middle for nothing with it. I hope that deals with that.
You've raised $7 million in this funding round. How will you be putting that to use?
So a few things. I think just continuous R&D. We've got a suite of products which we sell to law firms and in-house teams globally. So continue to innovate. Technology right now, there's a really relevant confluence between law and technology, and there's a lot of innovation going on in this space. And so we're hoping to double down and continue to improve our tech stack, as well as expansion. So we work with law firms around the world, Australia, North America, Europe, and we also have a global team. And so we want to continue to grow our team, and particularly the US, we've earmarked as a place of potential for growth.
I think I'm right in saying you received seed funding from Microsoft and Google.
Correct.
Have they participated in the latest funding round?
So they've been extremely useful to us over the years. They've given us advice, they've given us credits for key developments we've had to do, and they've given us, very importantly, mentoring and other types of advice. So the help that they've given us has greatly assisted us and got us to where we are. They didn't actually participate in this round, but we have a very good ongoing relationship with both firms.
The legal tech sector is getting pretty crowded, the likes of Robin AI, who we've had on this programme in the past. Do you think you can withstand that competition? Is there enough of the market for everyone?
Absolutely. I mean, Fergus, you may want to talk about this.
Yeah, no, I think there's plenty of room in the market. I think when you're looking at the way the technology is evolving at the moment, I think really since you have the advent of the language model and its capabilities and what it brings to what is ultimately a linguistic field, I think the door has just really opened up. And I think there are many and multiple use cases. I think there's plenty of room for innovation still within the actual tech sector. I think when you look, let's say, at what we're doing, for example, we're not doing what Robin AI do, for example. We do something completely different to them. But we're leveraging what we already have, and we're incorporating the generative AI aspects into that offering that we already give people, so that we're able to take what we've done and just build on that and enhance it and make it even better. I suppose at the end of the day, the solution isn't going to be, even though I know generative AI is the buzzword, I think the ultimate solution is not going to be a pure generative AI solution. I think it'll be a combination of ML, DL, some heavy NLP work, and a Gen AI component to it. But I think when you're looking, people are just kind of working out those use cases still, So, yeah, I think there's huge room for innovation.
I think one thing to add is also, I think just from a personal perspective, I'm very excited about a lot of the sort of what you're seeing right now. When we first started and came up with the idea for this business, you didn't see as much excitement about the legal space, yet alone the legal tech space. So to see the sort of, the plethora of startups that have come into this space, I think that's actually really exciting and helps grow the market for all of us. So I think there's plenty of pie there for everybody.
Well, still to come here on Business Life, I'll be telling you how the markets have done this afternoon. I'll be joined by Bill Dinning of Waverton Investment Management. Stay with us.
There's always more to the news than a headline. We want to discover, to delve a little deeper, to find out what's really going on. Explanation, analysis, the people at the heart of every story. I'm Neil Patterson, and this is the Sky News Daily Podcast. Alex Crawford joining us now from Ukraine.
Their personal possessions are all scattered around the place.
Our economics and data editor, Ed Conway, try and make sense of the big numbers for us.
Things can change incredibly quickly, and that's what they have done.
So, by the end, we'll hopefully all understand what's going on in the world just that little better. Available wherever you get your podcasts.
Push the protesters further back here. There's around 200 or 300 still remaining. I'm Dan Whitehead and I'm Sky News' West of England correspondent. This van goes onto the streets of Plymouth 7 days a week, 365 days a year.
These facilities at the moment are a lifesaver. It's all we've got.
From fishing communities to bustling cities, we spend every day reporting from across the region.
I'm going to have nowhere to live for about 3 or 4 months.
They are coming from the epicentre of what is now a global health pandemic. We were seeing and speaking to young women who were selling themselves right on the high street. Before Brexit, these oysters were being exported to the EU, but the trade stopped overnight. What's your feeling about the future then?
Blake, it'll be finished, I don't know.
Well, European equities are going into the weekend on a downward note. Here's how they finished in Europe. Well, as I say, downward. I mean, the DAX has broken even in Germany, and the MIB in Milan very, very slightly in positive territory, but not a day to shout about in Europe. Talking points today include Renault. The shares have risen by 4% in Paris after it launched a share buyback programme. Well, here in London, the FTSE 100 has finished the day in negative territory, off just under 0.25% to complete a second consecutive weekly decline. The distributor RS Group, older viewers will remember them as Electro Components, of course. That's the leading blue chip faller, off some 3.25%. That, of course, a hangover from its results on Wednesday. To the upside, well, the retail sales figures were disappointing, when M&S still continues to find supporters, up 2.25%. Obviously, it had results out on Wednesday. Meanwhile, the product testing specialist Intertek has risen by nearly 1.5%. They had a trading update out today. Outside the FTSE 100, the investment platform AJ Bell is down by nearly 4.5%, following selling by its founder Andy Bell. You might remember seeing him on the programme in the past. Over on Wall Street, the S&P 500 opened higher, but both it and the Dow Jones Industrial Average are set to suffer their first weekly loss in 4. Talking points today on Wall Street include Workday. The shares have fallen by some 14% after it cut its annual subscription revenues forecast. On the foreign exchange markets, here's the current picture. Sterling ahead by a third of 1% against the dollar, unchanged against the euro. The single currency, meanwhile, up by a similar amount against the greenback. As for the oil price, well, that today, earlier on, hit its lowest level since the 8th of February, but it has, in fact, since rallied, although it remains on course to complete a third weekly fall in 4. A barrel of Brent crude will currently set you back $81.95 a barrel. That is up 0.75% on the session. Well, with me this afternoon, as promised, is Bill Dinning, Chief Investment Officer at Waverton Investment Management. Bill, good to see you this afternoon. Retail sales figures, bit of a damp squib. I mean, they are prone to revision, we should say.
Yes. I think when a number is as negative relative to the expectation, it's quite surprising it got some publicity. As you say, damp squib, there's an old saying that the weather is an economist's best friend. You know, you can blame bad numbers on the weather. But there's obviously an element of truth to that. But, the consumers aren't very happy. Consumer confidence wasn't very good. And opinion polls are actually quite a good sort of secondary indicator of consumer sentiment. So however much economists might say that, the unemployment rate's quite low and why aren't people feeling a bit better, there's unambiguously people aren't feeling great, which will turn into not being wanting to spend very much money.
Yeah, I mean, would you have worries about the GDP print for this quarter, given that Q1 was better than expected? And a lot of that was driven by retail sales.
It was. And there was, I think it looks as though there was this sort of recovery, wasn't there, after the technical recession in the second half of last year, and it's possible that has faded a little bit. We've got 5 or 6 weeks to go till the end of the quarter. I think the quarterly numbers are more important than the monthly ones. But, things are definitely sluggish.
Yeah, well, of course, over the next 6 weeks, it's the election. How are investors looking at it?
Well, I think at the moment they're sort of shrugging it off. One of the things we're looking at is if there's something said during the election that sort of rattles investors, do we hear some policy by the presumed new government that would be unsettling to business? Then I think that would show up in some measure of sovereign concern. The one we're most interested in, I think, is probably the sterling euro rate. You pointed out just now it's at 1.17 euros per pound. That's actually a little bit above its sort of average since the Brexit referendum. So at the moment, sterling's looking okay. If sterling was to weaken against the euro, I would say that's one thing to look at to see if investors are nervous. But for now, I think it's not. Labour have been in the lead for so long that
it feels baked in, yeah. Why are you focusing specifically on how sterling trading against the euro?
Well, it's because it's been so stable. So it's averaged about 1.15 euros per pound since a week after the Brexit referendum in 2016. And it's traded within a range of 6% either side of that for all but 5 trading days for nearly 8 years. So that's remarkably stable. And so if it moves towards the bottom end of that range, i.e. if sterling weakens, then I think that would be an indicator that perhaps there wasn't a nervousness. And of course, to the economic historians, it's quite amusing, perhaps not amusing, but it's notable that obviously sterling got thrown out of the old exchange rate mechanism because it couldn't hold 6% either side of 2.9 Deutschmarks. Well, it's holding something similar against the euro.
Very interesting. One for our older viewers, that, Bill. What about over on Wall Street? I mean, I've just mentioned there, it's been both the S&P and the Dow have had a great few weeks. It looks to have snapped out of that bit this week.
It does, even though obviously the sort of darling stock at the moment, Nvidia, did remarkably well. So ex-Nvidia, things would even look a little bit sluggish. Now, some of this is macro. It's about the repricing of where interest rates are going to go in the future. So not long ago, the market was hoping that the Federal Reserve would start cutting rates in the summer. We were always a bit sceptical about that. Now that's pushed out till the end of the year. And there is this nervousness that some parts of the inflation picture look a little bit sticky. Even though headline inflation reported for April was better than expected, if you go into the weeds, you can make a case that it's looking stickier. So all the indicators are that the Fed isn't going to be cutting rates. So there'll be just nervousness if that bond yield moves up too much. That could be a negative.
And there was that unexpected drop in new home sales earlier in the week as well.
Yes, so there's a mixture, isn't there? There's some pricing pressure, there's strength in some parts of the service economy still, which is worrying investors that the Fed won't be able to cut for those reasons. But at the same time, there is some weakness. But housing is obviously one of the most interest rate sensitive parts of the market. So you would expect that might be a little bit weaker. I know we've been raising rates for 2 years, but I think having the interest rate sensitive parts of the economy are weaker than things like services, which may be less interest rate sensitive.
OK, Bill, got to leave it there. Good to see you as ever. Thanks for joining me. Well, that's it from me for today. Business Live is taking a short break for the next 6 weeks during the general election campaign, but fear not, I will still be around to bring you all the latest business news as and well it pops up. And there's at least, I'm told, one outside broadcast being planned. So do stay tuned to Sky News for all of that. And, of course, I'll be continuing to write for our digital platforms. There's a piece up from me right now on the latest machinations with the household energy price cap. And, of course, my piece from yesterday is still up there as well. What businesses are looking out for from the politicians as we head towards polling day on the 4th of July. That's it. As I say, thanks for joining me this afternoon. Look forward to seeing you over the next few weeks. Next up, Jonathan Samuels with the News Hour. Cheerio.